Welcome to our mid-year outlook, which this year we've titled Making Hay While the Sun Shines. And we remain with an optimistic view both from an economic and market perspective. Now today we are going to be doing two podcasts. The first one that you're looking at now is going to be looking at the macro environment, and I'm joined by my colleagues who are experts in their regions, and we'll go into detail on that. And I would encourage you also to tune in to our markets podcast, where we'll be going into great detail about the asset classes that we cover, notably of course equities, credit and government bonds. So here we are, the middle of 2026. So what has changed? What is our view? Well, from a view perspective, not a lot has changed. We still believe growth is going to be trend-like, which in itself is remarkable given the war in Iran and the impact that's had on energy prices. We believe that central banks are going to be focused on inflation, and that means they're going to be slightly more hawkish than they were at the start of the year. But we're not anticipating the start of a protracted tightening cycle. And the other important point is that the drivers of growth, we've still got fiscal initiatives coming through. We've not got the policy easing by the banks, but we have got what is looking as though it could well be one of the biggest capital spending cycles we've seen in a very long time, driven of course by the demand coming through from increased defense spending, by renewable energy, and of course AI spending coming through as well. So we'll be going into detail on that. So here we are looking at the macro side of things, and given that kind of still, you could say almost optimistic trend-like view of things, how do we get to that view? How come we're still optimistic? And on that front, I'm going to turn to our US and UK expert, Tom Levy, and ask Tom, how do we get to that point? The US has again been remarkably resilient, all things considered. Where do you think that growth is coming from in the US, and where do you think there's some vulnerabilities perhaps?
Look, I mean, at the beginning of the year, in our annual outlook, we emphasized a few growth drivers, and those are exactly the factors that still support US growth. So amongst those, a big factor is clearly fiscal spending. Remember, we talked about
the big beautiful bill.
Exactly, yeah. The big beautiful bill, all the tax refunds. So they were flowing through from March, April, May. So precisely during the time when global uncertainty was high, we had a spike in oil price due to the crisis in the Middle East. So that clearly supported consumer spending. And the other big driver that we already saw beginning of the year is the AI capex boom. So that spending also has, if anything, not slowed down, but actually accelerated. And that was another big growth driver in the US.
Now, you mentioned the big beautiful bill, and we see both from a consumer perspective, they're getting tax refunds. From a corporate perspective, there's incentives to be spending in that capex, as you say. But for the second half of the year, are they all fading? Do we need something else to take over that?
Well, clearly it is front-loaded, that is right, because the tax refunds, particularly the household ones, they are fading into the second half of the year. The corporate one might be a bit more spread out, but at the same time you also have the fading headwinds from tariffs, for example. And of course, the Trump administration did a lot to replace the tariffs that have been deemed illegal by the Supreme Court, but still the overall level is unlikely to be much higher, and compared to last year we do see a bit of a fading headwind there. So overall we still see a solid labor market, so wage growth should be holding up. Then the equity market, particularly in the US, is also helping to boost household wealth and income and sentiment. So currently we do expect that solid growth to last into the second half of the year.
So I guess the US is a bit above trend we would expect for this current year.
I would say so. Probably not too much, to be honest, because we also have some headwinds. And you mentioned initially central banks, and particularly also a slightly more hawkish Fed, at least verbally currently with the new chairman. So that did lead to a bit of a pickup in rates, which could weigh on the housing market in particular, and maybe broadly on the economy. But yes, overall, we would expect somewhat slightly above trend growth.
Now listen, I don't want to pour cold water on the party here, but you mentioned the new Fed chair. So tell me about that, because we had somebody who I think the market was expecting got the job because of their dovish credentials. We know that President Trump would like to see lower, not higher interest rates. But in that very first press conference, he came across as a Fed governor who, pointed out the deficiencies in the Fed, missing inflation for 5 consecutive years. So are we ended up with a hawk?
Look, in the end, he clearly came with a more hawkish message than many of us expected. And as you said, I mean, he went through a rigorous process, I would assume, to become the next Fed chairman. So I would assume that had he sold himself as being a particularly hawkish Fed chair, he probably wouldn't have received a job. So clearly, yeah, it was a hawkish surprise. Now, in my view, he clearly also gained credibility, because had he come in, the first action would be to basically undo everything that has been built up over the past few quarters and years, cut rates, despite the relatively robust environment that we just mentioned before. I think that would have undermined the credibility. So whether his words will be followed by actions remains to be seen. We talked about the second half briefly, but clearly the statements, the emphasis on price stability, the emphasis or the acknowledgement of having failed to reach inflation target for 5 years in a row, I think that definitely supported his credibility, and the Fed's.
But I guess in summary, I mean, your take is a bit above trend growth this year, and the Fed probably still on hold.
I would still expect the Fed to remain on hold. Markets currently are pricing in 1 to 2 rate hikes, but I still think, as we said, some of the growth drivers that have supported growth in the first half of the year will fade into the second half. At the same time, we have seen a massive drop in energy prices, which should also put a lid on inflation pressure, which probably will allow the Fed to remain on hold this year.
Very good. Now, thank you, Tom. Turning to you, Ross. Great story in the US, a growth a bit above trend, Fed on hold, it sounds like. Where's it all gone wrong in Europe? We started this year thinking, massive fiscal initiative coming through from Germany, spillover effect into the rest of Europe. What happened?
I would say let's look at Europe through 2 axes. I think are worth looking at here. So one is all of the stuff you mentioned with respect to fiscal policy is actually still coming through.
Right.
But it's boosting industries that are relatively small in a European context. We're talking about energy, infrastructure, build out, defense in particular. We know that's small, literally. I mean, Donald Trump talks about being unhappy about how small it is. The numbers we're seeing in terms of investment there and growth are considerable, and they are coming through. The axis I want to talk about there is, however, we have the positives from that, from a kind of investment and industrial perspective. We have this existing difficulty with business models that were previously dominant within Europe, particularly within Germany. Very high export driven industries there, automobiles, chemicals in general. Europe is still suffering massively from very high electricity prices, changes massively improvements in Chinese competitiveness and Chinese product quality in general. So that's one thing so we've seen the positive news, we're still seeing it coming through, but from a pure economic perspective, one is adding on one side, but there's a drag still coming through. The second thing I actually want to talk about is a trend we are still seeing in Europe, which is Southern Europe, previous poster child for kind of economic malaise, are still very, very strong. Spain in particular has actually added more manufacturing jobs since COVID than Germany has lost. The other thing as well is Italy's unemployment rate is actually now below Germany's unemployment rate. They've been helped massively by next generation EU packages, which will still for this year be kind of boosting growth generally.
So does that say more for Italy or less for Germany in terms of that employment switch?
So I think it's quite a balanced mixture there. I don't think it's just one or the other. Germany, as I mentioned in my kind of previous answer there, does suffer from its industrial mix, particularly was hard hit from the energy perspective, continues to be when you look at electricity costs, energy costs, input costs, generally very high, even labour market costs, very high compared to its competitive international markets. Spain, on the other hand, actually very low energy prices in a relative sense, and we've seen improvements there due to a massive build out of renewable energies and so on. There's also been some investment from a Chinese perspective into Spain as well, which does have some kind of political tensions it creates within Europe. But I think the answer to that question is it's kind of a bit of both.
And tell me, Ross, because your numbers have come down because the impact has been real. Had we not had that energy shock, what would the numbers look like? Would you have still believed they were going to be above trend? In other words, is this reduction purely down to this energy shock that we've seen?
So I think the energy shock is the single largest impact, but I don't think it's the only one. I think that we are seeing the impacts of basically the downsizing of some of these traditional industries just continuing to weigh purely on unemployment numbers themselves, or employment numbers coming down, but also just generally consumer confidence, is because of this deep sense, an understandable sense, particularly in Germany and in some of the other markets, France, for example, that the industrial bases are weakening, that consumers are fearing more for their jobs, they're spending less money, and I think you are seeing that in the data. However, the shock that we saw from an energy price perspective is literally in the data, the single largest contributor to what was a significant fall. Again, mainly in consumer confidence, less so in business confidence. But basically, we have an environment where consumption in Europe is still the dominant, largest part of the economy, and unfortunately, the reality is
So tell me this. I mean, we've kind of got weak and vulnerable growth. We have an energy shock. The ECB just moved interest rates up. Is that a policy mistake? And does this remind you of a certain Mr. Trichet back in the day when we had an interest rate hike only to reverse it again? So is this one or done, or is it one back to none again?
My base case here is it's going to be one and done. I think the risks, to my view, even though markets are still pricing in further interest rate rises, the risks, to my view, are skewed more towards it being unwound before another one is delivered. I think you are seeing, as I just mentioned there, with respect to the economic data generally, it's been disappointing, it's been weak. Tom mentioned it there in his answer before. The ECB hiked interest rates during the same week as the memorandum of understanding was signed with respect to US and Iran. Of course, there are risks around that, but the reality is right now that energy price situation is dramatically better from an inflation perspective than it was even in the ECB's mildest scenario right now. So we have kind of negative information on the economy generally. We have inflation expected to go up much less than was expected. And at the same time, we have the ECB hiking interest rates. To me, doesn't make sense, not warranted, and I think they are not going to be able to follow through on further hikes.
On that cheerful note, actually, to put it in context, I mean, we're still thinking growth isn't far away from trend, to be fair, for the other reasons you've mentioned. You could argue maybe Europe's become more idiosyncratic in terms of some of the drivers of that. You pointed to Spain, a little bit to Italy as well. So it is good that we're having elements of Europe, again, continuing to hold in pretty well. So, again, idiosyncrasies at play here. Turning to you, Ha, I mean, of all the regions with idiosyncrasies, we've got the Asian market. Thinking about China, thinking about what's going on in Japan with the new prime minister there. We'll be speaking in the next video about the whole tech cycle. But let's start with China, because China is a bit disappointing, is it not? I mean, great things coming from China we were expecting, but they still have a property problem. They've still got domestic consumption being a problem. I guess the good thing is that exports continue to boom. Is this too lopsided an economy? Is this an economy that is dependent on the rest of the world? You think about the robustness of China, how well they've done during this oil situation. Maybe tell us a little bit about why has China managed to weather the oil challenges, but also, is it too dependent on all of us buying their stuff?
So China is full of surprise, both on the negative side and positive side. Maybe take a step back on this energy crisis that we have in the Middle East. When we enter this crisis, we see 50% of the oil from the Middle East is flowing to China. And we thought, well, if we have that drop to the level that we see the vessel crossing across the Strait of Hormuz go down to zero, China would be in a very bad situation. But actually, China stood out as the most resilient economy.
How is that possible?
Because they have just so much oil reserve and they have built it up for quite a period of time. It's more like a strategic priority from the Chinese authority. And that also bodes very well with how we see Chinese economy, because there is 100% priority that being put in the new sector, in the energy, for example, in the sector that generate a lot of productivity according to the leadership's idea, for example, renewable energy and tech semiconductors, though are the priority. But we also have another side of China, which is China still struggling with the property market, even though we see a little bit of rebound on the first tier city, but it's still way too weak. And what has been quite remarkable is that for the first time, after a long time, I see consumption for the last month actually going to a negative territory on the growth.
Negative territory.
Yes, on a year-on-year basis. Of course, a lot will argue that because of the base effect, but clearly we had consumers continue to be very pessimistic in the economy.
So what gets a consumer to turn? Is it these housing sectors? I mean, you mentioned the tier one looking a bit better. Is that what it takes for consumers to feel better and start spending again?
I think that's the first start. threat because you can see that Chinese consumers or Chinese citizens, they don't have many channels to save their money, right? So equity market also quite volatile. So it's end up with property market as one of the choices in the past where they lock up all the savings. So you can imagine that if you lock all your savings in the property market that go down by value by double digit every year, and of course you're pessimistic, of course you're not going to spend. So that need to turn first. And we have some encouraging sign that is happening in the tier 1 market. But I think China is a big economy. We still have a lot of tier 2 and tier 3 cities are still flooded with basically inventories.
But why is the government not doing more? Why are they not doing more to prop up consumption and demand? Do they feel they don't need to? It's moving in the right direction. They don't want to, or they feel that they need to support it? What's your take on that?
I think because the governments really want to focus on something they call long term, they rather accept some kind of short term pains through this property market. All the intention there is to keep the flow and make sure that this is not going to cause a systemic collapse of the system or of the economy. They will do whatever it takes to prevent that scenario. But if not that, it's just a pain lingering for years. They will just pull so much resource into the tech sector to basically fundamentally win the tech race globally. And China actually making a lot of progress on that front. I think it's only behind US and quite far ahead from compared with Europe in many measures.
But I'm still worried, $1.3 trillion surplus, that is a dependency, I think, for China. And we have to hope that one, global growth stays in, the demand holds up, and it gives them time in order to fix their domestic economy, which I guess is your longer term view.
I mean, in that way, you can see how China have play a stabilizing role through this crisis, right? They cut oil import drastically while still maintaining production lines because they don't want global recession because that's going to hit their growth and they're going to...
That's true, and that's taken the pressure off some of the demand for oil that we've seen as they've backed off. Okay, so China, I guess the risk is probably still a bit to the downside for this year, but you're not expecting any significant policy stimulus. Tell me about Japan, because this is a country I know you've written quite a lot about. We've got a relatively new prime minister there with kind of a populist mandate. Japan seems to have become like the rest of the world. They've got inflation, they've got higher interest rates. So what's the outlook for Japan, and kind of what is the biggest risk to that kind of populist agenda and further government spending?
So Japan dynamism is real. I would conclude that because for a long time they don't have inflation, they don't have growth, interest rates very low, and now we see in corporate profitability, for example, it's picking up quite sharply, and also companies finally spending on capex again. So that is quite positive. Now the rest, of course, we still have Japan as one of the most indebted country in the world. You look at the debt to GDP ratio, is way too high.
But it's getting better at the margin with nominal, growth coming through quite high.
But at the same time, from the fiscal front point of view, if the Prime Minister continue to push on that front, and you see that stress coming from the long-term bond years, especially 10 years, right? So our forecast is that there are certain like a buffer to go, but at one point it's become painful that basically the government got to take a step back.
Just to carry the cost of that debt,
Exactly.
And now you changed because you wrote a topic on this, which I would encourage people to look at. But back then you were thinking bond yields got up to 2.8. Well, we got to 2.8 10-year yields, but you were mentioning 3% is probably the cap. Is 3% still the cap? Is that the ultimate pain threshold that forces policy change?
I would think so.
Okay.
Yeah. Also, of course, there are a lot of moving parts here. How about inflation expectation? How about real growth? But that seems to be where I think the government got to take a step back, and 2.8 is still my forecast for the end of this year.
Very good. Now we speak about bond yields, perhaps curtailing some policy ambitions. Tom, you're standing next to I can't resist my little island, my homeland. We're going to have a new Prime Minister who is severely curtailed, the straitjacket of the debt levels, the deficits that we've got. Are you expecting anything profound in the remaining part of this year into next year from a new Prime Minister?
Quite honestly, it's rather unlikely because remember, Keir Starmer was voted into office with a phenomenal majority, and even though, of course, you could now argue maybe they should have taken the opportunity. But if you're not able to change course with such a majority, then it will be challenging for any prime minister. And even now we see that Andy Burnham, which is very likely will be the next prime minister, he will still be restricted by the same fiscal rules. And he mentioned that he doesn't want to play around with the fiscal rules, and I wouldn't recommend to do so because we remember Liz Truss. So that clearly wouldn't be an option. So the framework, the situation is a very unfortunate one. It's modest growth, it's a planning uncertainty, the fiscal situation is fragile. So I hope that the UK is moving in the right direction by maybe opening up the markets, by incentivizing more investment, by streamlining some planning rules. But quite honestly, currently, I don't expect the big move, the big change. And it is really because the framework is such an unfortunate one. So they will still be kind of limited to also what the global economy is giving.
Well, listen, we'll go into detail about the gilt market in the financial market section, but I think it's fair to say whether it's Japan, whether it's the UK, whether it's even the United States itself, the bond markets matter. That volatility is a constraining feature, and a very powerful constraining feature for policies, I think, or sort of profligate policies, at least there. Now, I want to again switch gear. We're going to go to Gustavo, who's based in Chile. So much going on in your region, Gustavo, but maybe starting off with a high-level question. The USMCA, the agreement for the region with the United States and Canada, that's still up for renewal, right? So what is happening? What's happening in terms of the direction of travel? Is the whole thing going to be scuppered? Is President going to Trump dismantle something that he, I think, originally put in place? What's your overview takeaway to start with?
Absolutely, Guy. I think, right now we are on the clear ongoing negotiations. Originally, we have this key deadline that we have on for July the 1st, but we have been seeing that negotiations are lagging in terms of they will extend beyond that deadline. And of course, Trump has also put in place these threats, these harsh threats to get out of the deal. But the reality is that the USMCA will continue, even though that will not be renegotiated or extended with this base case of this 16-year period. So far, right now, our base case could be that annual reviews will be in place. That would guarantee that all the benefits in terms of trades on lower tariffs, that all the three partners continue to benefit. But this uncertainty in terms of the backdrop, in terms of the rules that will continue to go further, that may be the bad sign for this kind of a deal. So that would be our base case right now, at least until news will come up from these negotiations that currently are ongoing.
And maybe tying that to the prospects for Mexico, because Mexico, I guess, is the country that is most exposed to that, with something like 85% of exports going to the United States. What are you seeing there on the domestic front and also in that kind of political front to give you more or less confidence in the growth dynamic for Mexico for the next 6 to 9 months?
Yes, for sure. Well, so far, last year, Mexico proved to be more resilient than expected, but still quite below trend. For this year, we have this improvement, but still below trend. I think, and when you look at the breakdown of the GDP performance, clearly the investment continue to be the drag in terms of economic growth for Mexico, and clearly reflecting this low business sentiment that continue to weigh on investment and capex buildup. I think the nearshoring story remains its place, but at least until we have this uncertainty, that will continue to weigh on. And that's the thing. When you see the export dynamics that you pointed out, that is quite dependent on export to the US, they have been quite solid in terms of export. So not that a threat on that, at least on the short term. But when you are looking on the longer term, when you have to build and you have to spend a lot of capex, but that is when the economy has lagged behind, and then clearly it reflects this uncertainty around this key USMCA trade renegotiation. So that is our key focus right now in terms of how to evolve, and so far remains quite cloudy on that front.
And maybe just a quick one on Brazil. You know, big economy. Clearly, it's one that has challenge is we've had very, very penal interest rates, obviously, to bring down inflation. They were very aggressive in moving rates up, and rightly did it to bring that inflation dynamic now. So how do you think that pans out? Are we going to see now a series of rate cuts to get back towards a more normal level, or is inflation still a challenge in your mind?
Well, we had big expectations from Brazil. I think we have like this inflection point that clearly the Middle East conflict that when erupted was coincided when the central bank began to start to this easing cycle that was long awaited. We remember we had these record high levels at 15% of the policy's rate, but going into that easing cycle that was about to begin, well, the Middle East erupt. That it did not stop the central bank to start its easing cycle, but has started with a slower pace. And given the inflation dynamic has deteriorated from that period, in addition with a lot of policy-driven measures that continue to weigh on or to support this consumption, because it's quite striking that you have this resilient economy, even though you have this 10% real rates. But this is more reflecting this policy that is short-lived. We are heading to this election, and after that, maybe we can see a more decelerated economy. Yeah. But in terms of policy, clearly has deteriorated in terms of the scope, and there is increasing risk. We have a potential pause on the easing cycle going into the second half of the year.
Very good. Thank you, Gustavo. Now, kind of putting all of that together, it's not a bad macro environment that we're speaking about around the key regions. I want to turn to you, Puneet. You've been unusually quiet. Are you feeling okay? All good?
Yeah,
all good.
All good.
So listen, we've spoken about the macro elements here. I said right at the beginning, one of the key components of the growth dynamic of the current macro environment that we're in is capital spending, particularly coming from a lot of these hyperscalers. I mean, you spend your days also focused on the credit markets. We've seen a lot of issuance there. How concerned or relaxed are you about that raising of funding? And do you think this is going to have a material impact in terms of the macro dynamic throughout the remainder of this year? Are you more concerned, or are you more kind of optimistic about that?
I would say I'm optimistic, because I think the credit markets are the ideal fuel to basically rocket the AI expansion.
Yeah.
And I think, we have seen in 2026 already issuance which exceeds 2025, which was significantly higher than what we saw over the last few years. So companies are coming up with a lot of big jumbo deals, the way we call them, and they're being massively oversubscribed. So over the last couple of weeks itself, we had NVIDIA and SpaceX both bringing $25 billion deals to the market, and they had 90 billion or so of orders. So I think one thing which is worth saying is that the credit markets remain ready and open to actually fund these hyperscalers, simply because they are actually generally very good and strong balance sheets with diversified business models and strong cash generation, and in many cases strong cash balances as well. So I think the fact that their share in the market in credit is actually increasing quite rapidly, to me there is a little bit of a comfort from their balance sheet strength that I get for that. And the other point I would make is that this entire AI expansion being led by the hyperscalers is a good thing, because they are the strongest part of the market from a credit worthiness perspective to leverage up. And they're not leveraging up massively. I mean, I think over the next couple of years, there are forecasts of the capex being in the trillions or over $1 trillion or so, but they are also going to generate massive amounts of cash.
Absolutely, yeah.
So and they will raise some debt. Many of them are raising equities.
So these hyperscalers themselves are not going to curtail growth or be an impediment to that. If anything, they're still facilitating that dynamic.
Yes.
Okay. Now listen, one other thing. I know when you're not looking at hyperscalers, you're looking at banks. Lucky guy. What about lending standards? Because we spoke a little bit about the shift in terms of policy, moving from kind of easing monetary policy to at the margin tightening monetary policy. So what are you seeing in the lending data? What are you seeing in the banks? And how much of a concern is that to the growth dynamic? Particularly, I guess, maybe smaller parts of societies, of companies are being more impacted than others.
Exactly. So I think, so there are two parts of the world in a way, or the corporate world as well as the consumers as well. I mean, there's a lot of talk around this K-shaped economy. I think that also applies to companies as such. So for the large issuers, I mean, we just discussed these jumbo deals coming through and getting a lot of subscription. There is no problem. Funding is available in plenty, and spreads are low as well. But for the smaller companies, more levered borrowers in the market, things are still tough and challenging. And they have been tough and challenging since the Fed started raising rates 3 years ago, because they are in a challenging environment. So lending standards are tight, not very tight, but they are, marginally tight. And if you look at the bankruptcy rates of small companies, there's a marginal improvement, but nevertheless, I mean, they're high compared to any time we have seen, outside of recessions.
Forget that, given how tight spreads are, you think everything is hunky-dory, and yet there is this pain point or part of society that is really struggling.
Yes, and including small businesses.
Well, listen, we're going to go into much more detail on the financials in the next podcast, as we mentioned. But really turning back down to the view, as you've heard from the team, and I do encourage you to please look at the written material that we put out, our weekly, our monthly, our quarterlies. All of these things are available on Zurich.com, where the experts really tell us what they're seeing and what they're feeling. But as we hit this kind of mid-year, as I said, our title, Making Hay While the Sun Shines, still an optimistic view of things. We're still seeing this trend-like growth, despite all the impediments that have been thrown at. Societies have a great way of finding their way around obstacles. And once again, it's exactly what we've seen given this energy shock coming from the Middle East. Again, the central banks more likely to be at the margin a little bit more hawkish than we had thought at the beginning of the year. But the offset to this, of course, is that the capital spending boom continues, and as you've heard, is very well funded and financed, and we think has got a lot further to run. The numbers are big, but in a historic perspective, we think they have got still quite a long way to go. So we're not overly worried about that in the near term. Inflation, yes, it is elevated. Yes, it's missing central bank targets, but with the oil price coming back down quite rapidly, the month-on-month inflation numbers are going to be getting better. Yes, key components within the tech space are rising, but they're not such a big concern, certainly in terms of the composition of the CPI numbers as well. So we think that is manageable too. So the net is not a bad environment, but if you want to hear more and if you want to see about or hear how the financial markets play a part in that, then please do tune into our next podcast, where we'll be drilling in terms of what is actually happening in the bonds, equities and credit markets. But as always, thank you very much for viewing. We do appreciate it. Please do look at all the publications. Leave your comments, leave your thoughts. They're all available on Zurich.com, and we'll speak to you very soon.